Many of you know that if you make a lot of money one year, that it could cause your Medicare Part B as in boy and D as in drugs to go up for 1 year. Then if you're married and you're both on Medicare and you're filing your taxes together, both of you could pay more for Medicare. You might pay an extra $60 a month. You might pay an extra $200, $300, $400, $500 a month based on your income from 2 years ago. The government looks back 2 years. So you're 2 years from retirement, or you're whatever, you're already at 65, or you're already on Medicare, but you're like, okay, is there a way I could avoid triggering this surcharge? And it's called IRMAA, IRMAA. There's a lot more information on our website, themedicarefamily.com. Go to the top of the page where the little search bar is. Search IRMAA. It'll tell you the brackets for next year for married, single, or married filing separately. And then how much extra you would pay every month. So it gives you some idea. It's tagged to inflation. So if you're ready to do something this year, you can kind of extrapolate what it would be for 2 years from now with assuming 3% inflation per year. So it's not an exact science, but you can kind of guess what it would be. So what could I do this year that could trigger the IRMAA? Sell a property, sell some land, sell a house, sell a vacation house. If anything that I sell that I get a profit on above my tax exemption, pure profit, capital gains, boom. That's typically what triggers IRMAA. People have the second marriage and they get married. They don't need the two houses. And like, oh, we'll just sell one. Now they pay an extra $6,000 for their Medicare for a year. So how can you avoid that? Well, you could just rent it. A lot of people don't want to rent it. They want to get rid of it. So you just know you're going to have to bite the bullet and you'll be paying IRMAA for a year. Remember, whatever you do this year won't hit you for 2 years. Now, what could you do to try to get your income under the limit? You could, if you're still working, you could max out your 401k, 403b, any of your tax deferred accounts, IRA, because that reduces your income because you're trying to get your income below the threshold that triggers the IRMAA. So that is something you could do. Now, contributing to a Roth doesn't do anything because you're getting the income, you're paying taxes on it, and that taxable income is what they determine if you'll pay more for Medicare. But maxing out your 401k, your IRA, your 403b, those tax deferred things, those can help you. Now, they can also hurt you, and that is the second thing that typically triggers IRMAA. And that is you retire. You retired last year and you thought, you know what? Why did I keep my money there? I'm not really sure what I want to do with my 401k money yet, but I don't want it at my old employer. So you withdraw it all and you put it in your checking or your savings account, and you're going to deal with this later. When you withdrew it and put it in your checking and savings account, it became taxable. So let's say you took out $100,000. Boom, you have guaranteed you're going to have to pay Medicare IRMAA 2 years from now for a whole year. So that is something you can strategize, that you don't take it all out, or you might transfer it to an IRA, which wouldn't cause taxes. Or there's different things you can do. Maybe just take a little bit out every year so you're not triggering IRMAA. That's where you can work with a financial planner, a certified financial planner, to help you look at all your sources of income and your Social Security and your pension and see how much we can take out before we trigger IRMAA. Because you only have to go over $1. You make $1 too much, boom, you're paying more for Medicare. There are 5 brackets, so just $1 is only going to put you at the first bracket, but nobody wants to waste that money. Doesn't matter what insurance company you go with. If you go with a Medicare Supplement or Medicare Advantage, or the insurance companies all have to get it and send it to the government. So you can't escape it unless you just don't have Medicare. You just don't have Part B, or you don't have Part D. So Medicare IRMAA, we call it a surcharge for high earners. If you get a letter that says you're getting hit with it, first thing you do is read that letter scrupulously, because if you're getting hit with it because you retired last year, 2 years ago, and now you don't have that income that you had 2 years ago, you immediately want to file an appeal. And that appeal will succeed. You have to show proof that you're retired. That's an easy one. That's what most people do when they get that IRMAA. But if you get the IRMAA determination letter because you sold a farm, you sold a vacation house, you took a lot of money out of your 401k, there's no appeal in it. You can try it, but you will not win that appeal. If you do get hit with IRMAA, it's only for 1 calendar year. So Medicare and the IRS, they talk and they readjust that every year. So if you get that determination letter, give us a call at the Medicare Family. Would love to help you with that because that can be a very expensive mistake. Thanks for tuning in.
If you like this video, you might really like this video. Check it out. And we'd appreciate if you subscribe to our channel so you never miss a great video. We put out one every week. Check in the description below this video for a link to our cheat sheet on Social Security and Medicare. And you can also give us a comment. If you have a specific question, always feel free to call us or email us at the Medicare Family.